The US dollar, which has dominated global trade for over 50 years, is facing its biggest challenge yet, and the replacement might not be what you think. Today, we're diving deep into one of the most consequential economic shifts of our lifetime. We'll explore exactly what's happening to the dollar, why it matters to your wallet, and what currencies or systems are positioning themselves to take its place. By the end of this video, you'll understand the forces reshaping the global financial order and how to position yourself for what comes next. Let me start with a story that perfectly illustrates what we're dealing with. In 1928, if you held a gold certificate, you could walk into any bank and exchange it for actual gold. These certificates never said Federal Reserve Note anywhere on them. They represented real money backed by something tangible. But in 1971, facing potential bankruptcy, the United States made a historic decision that changed everything. President Nixon took America off the gold standard, ending the Bretton Woods system that had anchored global currencies to gold. Suddenly, the dollar became the world's reserve currency without being backed by anything except trust and military might. The world essentially agreed to a new deal. All countries would sell their goods and energy for dollars, then recycle those dollars back into U.S. assets like treasury bonds and stocks. The system worked brilliantly for America. It allowed the country to run massive trade deficits, import more than it exported, and maintain a lifestyle beyond its productive means. The demand for dollars stayed high because countries needed them for international trade, and the U.S. military ensured no one could challenge this arrangement. But here's where things get interesting. That system is now breaking down. And we're witnessing the early stages of a monetary transition that happens perhaps once every few generations. The evidence is everywhere if you know where to look. Central banks around the world are quietly diversifying away from dollar-heavy reserves. According to International Monetary Fund data, central bank gold purchases reached their highest levels in over 5 decades during 2022 and 2023. China, as the central bank alone, added over 300 tons of gold to its reserves in 2023, while simultaneously reducing its holdings of U.S. Treasury securities. The numbers tell a compelling story. In 2000, the dollar represented about 70% of global foreign exchange reserves. By 2023, that figure had dropped to approximately 58%. Meanwhile, gold's share of central bank reserves has been steadily climbing, reaching levels not seen since the 1970s. But it's not just about gold. China has built an entire parallel payment system that bypasses U.S. banks entirely. The Cross-Border Interbank Payment System, or CIPS, now processes over $80 billion worth of transactions annually. Russia, after facing sanctions, has dramatically accelerated its de-dollarization efforts, conducting trade with major partners in rubles, yuan, and other currencies. So what's actually replacing the dollar? The answer isn't simple because we're not moving toward a single replacement currency. Instead, we're transitioning to what economists call a multipolar monetary system. Let's break down the key contenders and systems emerging to challenge dollar dominance. First, there's the Chinese yuan, backed by the world's second largest economy. China has been methodically internationalizing its currency through bilateral trade agreements, currency swap lines with over 40 countries, and the establishment of yuan clearing centers in major financial hubs. The yuan now accounts for roughly 7% of global payments, up from virtually 0 2 decades ago. However, the yuan faces significant obstacles to becoming a true dollar replacement. China maintains strict capital controls, limiting the free flow of yuan internationally. Its financial markets, while large, lack the depth and liquidity of U.S. markets. Most importantly, China's political system creates uncertainty for foreign holders of yuan-denominated assets. Second, we have the potential for a BRICS currency. The BRICS nations, comprising Brazil, Russia, India, China, and South Africa, plus recently added members like Saudi Arabia and UAE, represent about 40% of global population and roughly 25% of global GDP. They've discussed creating a common currency for trade settlements, potentially backed by a basket of commodities, including gold, oil, and agricultural products. While still in early conceptual stages, a BRICS currency could provide an alternative for countries seeking to reduce dollar dependency without fully embracing any single national currency. The challenge lies in coordinating monetary policy across vastly different economies with sometimes conflicting interests. Third, there's the resurgence of gold as a monetary anchor. Unlike fiat currencies, gold cannot be printed or manipulated by any single government. Central banks have been net buyers of gold for 13 consecutive years, with purchases accelerating dramatically since 2022. The Basel III banking regulations, implemented in 2022, now treat gold as a Tier 1 asset, giving it equal status to cash and government bonds on bank balance sheets. This regulatory change has profound implications. Banks can now hold gold as reserves without the previous discounts applied to its value, making it more attractive as a store of value and potential settlement medium for international trade. Fourth, we're seeing the emergence of central bank digital currencies, or CBDCs. Over 90 countries are exploring or piloting digital versions of their national currencies. China's digital yuan is already being tested in major cities, while the European Central Bank is advancing plans for a digital euro. CBDCs could reshape international payments by reducing settlement times and costs, potentially diminishing the dollar's role as an intermediary currency. However, they also raise significant concerns about privacy and government surveillance of financial transactions. But here's what makes this transition particularly complex. The US dollar's dominance is not just about economics. It's about geopolitics, military power, and institutional inertia built over decades. The dollar benefits from what economists call network effects. The more people use it, the more valuable it becomes. About 88% of all foreign exchange transactions involve the dollar. Roughly 60% of international trade is invoiced in dollars, even for trades that don't involve the United States. Oil, the world's most important commodity, is still predominantly priced in dollars. These network effects create enormous switching costs for moving away from the dollar system. Countries need dollar reserves to participate in global trade. Banks need dollar funding to serve international clients. Even critics of American policy find it difficult to completely abandon the dollar system. However, these network effects can also work in reverse. If enough participants begin using alternative systems, the dollar's utility could diminish rapidly. We are potentially approaching a tipping point where the costs of dollar dependency begin to outweigh the benefits for many countries. Let me give you a concrete example of how this transition affects real people. Consider the minimum wage worker in America today compared to one in the late 1960s. In 1968, the federal minimum wage was about $1.60 per hour. At that time, gold traded around $35 per ounce, meaning a minimum wage worker could buy about 1.8 ounces of gold with 1 week's wages. Today, the federal minimum wage is $7.25 per hour, or about $290 for a 40-hour week. With gold trading around $4,900 per ounce, that same worker would need to work a little over 30 weeks to buy the same 1.8 ounces of gold. This illustrates how currency debasement affects purchasing power over time. Now, why might the US actually want a weaker dollar? This seems counterintuitive, but there are compelling reasons. America faces what economists call the Triffin dilemma. To supply the world with dollars for international trade, the US must run trade deficits, importing more than it exports. But persistent deficits eventually undermine confidence in the currency. It's an inherent contradiction in being the world's reserve currency issuer. A controlled weakening of the dollar could help resolve this dilemma. It would make American exports more competitive, potentially reducing trade deficits. It would make the real burden of America's massive debt load more manageable over time. And it could encourage the reshoring of manufacturing that was offshored during decades of dollar strength. President Trump has hinted at this strategy. When asked about the dollar's recent weakness, he responded positively, saying it was great for American business. This represents a significant shift from the traditional strong dollar policy that dominated American economic thinking for decades. But currency transitions are never smooth or predictable. They typically involve significant volatility and uncertainty as markets struggle to price assets in a changing monetary landscape. We're already seeing this volatility across asset classes. Gold has reached multiple all-time highs. Bitcoin and other cryptocurrencies experience extreme price swings as investors search for alternatives to traditional currencies. Stock markets gyrate wildly as investors try to position for different scenarios. The transition also creates winners and losers within different segments of society. Those who own real assets, productive businesses, land, or commodities may benefit as these assets tend to maintain value during currency transitions. Those dependent primarily on fixed incomes or cash savings may find their purchasing power eroded. So, what specific systems and currencies are most likely to emerge as alternatives to dollar dominance? Regional currency blocks seem increasingly likely. The European Union already demonstrates how this can work with the euro serving multiple national economies. We might see similar arrangements develop around other major powers. China and its trading partners could develop a yuan-based system for their region. Russia and its allies might create a ruble or gold-backed arrangement. The Middle East could potentially develop an energy-backed currency system. Commodity-backed currencies are gaining renewed interest. Oil-rich nations are exploring currencies tied to energy baskets. Agricultural powers might develop food-backed monetary systems. The key insight is that real stuff, things people actually need, provide more reliable value than promises from any particular government. Digital currencies, both private and government issued, will likely play important roles. Bitcoin, despite its volatility, has demonstrated remarkable resilience and adoption as a store of value independent of any government. Stablecoins pegged to baskets of currencies or commodities could facilitate international trade without dollar dependency. However, the most likely scenario isn't the complete replacement of the dollar, but rather its gradual marginalization as one option among many in a more diverse monetary ecosystem. This transition has profound implications for different types of investors and workers. If you're primarily invested in U.S. stocks and bonds, you may benefit from continued inflows as foreign central banks diversify away from treasuries and into risk assets. However, you're also exposed to potential volatility as monetary systems shift. If you work in export industries, a weaker dollar could boost demand for American-made goods, potentially leading to higher wages and more jobs. But if you work in import-dependent industries or rely on foreign goods for your lifestyle, costs could rise significantly. Real estate investors might benefit, as property often serves as a hedge against currency debasement, but the specific impacts will vary dramatically by location, with some areas potentially experiencing capital flight, while others see increased investment. The timeline for this transition matters enormously. Rapid changes could create significant disruption and hardship. Gradual shifts over decades might allow for smoother adjustments. Unfortunately, monetary transitions often involve periods of instability regardless of policymakers' intentions. Geopolitical tensions could accelerate the process. Trade wars, sanctions, or military conflicts might force countries to develop alternative systems more quickly than they would prefer. Climate change impacts, resource scarcity, or other global challenges could also influence the pace and direction of monetary evolution. Central banks face difficult choices during this transition. They must balance maintaining stability in the current system while preparing for potential alternatives. This often means accumulating diverse reserves, developing new payment systems, and creating contingency plans for different scenarios. The Federal Reserve finds itself in a particularly complex position. As the issuer of the world's primary reserve currency, it has immense power but also enormous responsibility. Its policy decisions affect not just Americans, but people worldwide who depend on dollar-based systems. Recent Fed communications suggest awareness of these challenges. While officials rarely speak directly about dollar strength or weakness, their policies increasingly reflect the need to balance domestic economic goals with global monetary stability. For individual investors and savers, this transition creates both opportunities and risks. Traditional portfolio allocation strategies based on stocks and bonds in a stable dollar system may prove inadequate for a multipolar monetary world. Diversification takes on new meaning in this context. Instead of just diversifying across asset classes, investors might need to diversify across monetary systems, holding assets denominated in different currencies or backed by different types of real value. Physical assets with intrinsic utility become more attractive. Energy infrastructure, agricultural land, precious metals, and other real assets might outperform financial assets during periods of monetary instability. Skills and human capital also become more valuable during transitions. People who can produce useful goods or services maintain their economic value regardless of which currency dominates. Technical skills, practical abilities, and entrepreneurial capabilities often appreciate during periods of systematic change. Geographic diversification might also prove important. Having connections, assets, or opportunities in multiple countries or regions could provide options, as different areas develop different monetary arrangements. The replacement of the US dollar won't happen overnight, and it may never be complete. What we're witnessing is the gradual emergence of a more complex, multipolar monetary system where no single currency dominates as thoroughly as the dollar has for the past half-century. This transition reflects broader shifts in global economic and political power. As emerging economies grow and develop their own financial systems, their dependence on dollar-based infrastructure naturally diminishes. Technological advances make alternative payment systems more feasible than ever before. The ultimate shape of the post-dollar international monetary system remains uncertain. It could involve multiple reserve currencies, commodity-backed arrangements, digital systems, or combinations we haven't yet imagined. What seems clear is that the era of unchallenged dollar dominance is ending. For Americans, this transition presents both challenges and opportunities. The privileges of reserve currency status, including the ability to import more than the country exports and to finance government spending through foreign purchases of treasury bonds, may gradually diminish. However, a more competitive currency could revitalize American manufacturing and exports. It could force the economy to become more productive and self-reliant rather than dependent on financial engineering and debt accumulation. The key for individuals is to understand these trends and position themselves accordingly. This doesn't mean panic or dramatic changes, but rather thoughtful preparation for a world where currency relationships are more fluid and uncertain. Education becomes crucial during such transitions. Understanding how different monetary systems work, how currencies interact with real economic value, and how to evaluate investment options in an unstable monetary environment can make the difference between thriving and merely surviving. As we watch this historic transition unfold, remember that monetary systems are human creations designed to facilitate trade and store value. When existing systems no longer serve these purposes effectively, people naturally develop alternatives. The dollar, as the eventual replacement, will likely emerge from the same practical needs that originally made the dollar dominant: the requirement for a trusted, stable, and widely accepted medium of exchange and store of value. Whatever system or combination of systems eventually fills this role will succeed, based on their ability to provide these functions better than current alternatives. The coming years will be crucial in determining how this transition plays out. Policy decisions, technological developments, geopolitical events, and market forces will all influence which alternatives gain traction and how quickly changes occur. For viewers seeking to navigate this transition successfully, the most important advice is to stay informed, remain flexible, and focus on building real value rather than just financial wealth. In a world of changing currencies and unstable monetary systems, the most reliable investments are often the simplest: productive skills, useful relationships, and assets that provide genuine utility regardless of which particular pieces of paper or digital tokens society chooses to call money. The replacement of the US dollar represents one of the most significant economic transformations of our lifetime. By understanding the forces driving this change and preparing thoughtfully for different outcomes, we can position ourselves not just to survive this transition, but to thrive in whatever monetary system emerges from it. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.